Ever wondered who controls the money in your pocket? You may be surprised to learn that it's not the government but the Federal Reserve, the central banking system of the United States. This powerful institution has a mammoth role in shaping our nation's monetary policy and maintaining financial stability. It's like the puppet master pulling the strings of the U.S. economy. But how did it come into existence? Who thought of such an institution? So what led to the creation of this powerful institution? To understand the origin of the Federal Reserve, we must travel back to the 19th century. The United States was a young nation, still finding its feet in the global arena. Its banking system, much like the country, was in its infancy, decentralized, and somewhat chaotic. While this decentralized approach to banking allowed for regional flexibility, it also left the system vulnerable to shocks and crises. Let's take a quick detour to the year 1907, often remembered in history as the year of the Great Panic. The Panic of 1907 was a financial crisis that almost crippled the American economy. It began with a failed attempt to corner the market by a group of speculators who had overextended their resources. The fallout was swift and brutal. Trust companies and banks found themselves in a liquidity crunch as depositors rushed to withdraw their money. The stock market plummeted, credit dried up, and businesses started to fail. The crisis laid bare the inherent weaknesses of the American banking system. There was no central authority to step in and provide liquidity during a crisis. The decentralized nature of the system meant that the impact of the crisis varied across the country, with some regions hit harder than others. In the aftermath of the panic, there were widespread calls for reform. Economists, politicians, and business leaders alike recognized the need for a centralized banking authority that could provide stability in times of crisis. There was a growing consensus that the U.S. needed a more robust and resilient banking system to support its rapidly growing economy. The 1907 financial crisis was the final straw, setting the stage for the creation of the Federal Reserve. It served as a stark reminder of the dangers of a decentralized banking system and the urgent need for reform. This was the prelude to the Federal Reserve, a central banking system designed to provide the stability and resilience that the American economy so desperately needed. Enter Senator Nelson Aldrich and the Aldrich Plan. A powerful personality in the corridors of American politics, Aldrich, in the early 20th century, proposed what came to be known as the Aldrich Plan. This plan was his solution to the financial instability that had plagued the United States for decades. At the heart of the Aldrich Plan was the creation of a National Reserve Association. This association was designed to serve as a central bank, offering fiscal stability and a safeguard against financial crises. It would hold a portion of the nation's reserves, issue currency, and even act as the government's fiscal agent. This was a revolutionary idea for the time. It aimed to centralize control of the financial system, something that had been lacking and had led to considerable instability in the past. However, the Aldrich Plan was met with fierce opposition. Critics feared that it would lead to Wall Street domination and that the nation's financial system would fall into the hands of a select few. They argued that such a concentration of power was against the very principles that the United States was built upon. These critics were not without influence, and their reservations held sway. The Aldrich Plan, despite its revolutionary ideas, failed to pass. The idea of a central banking system was too radical, too new, and it met with strong resistance from those who feared that it would lead to an unhealthy concentration of power. However, the Aldrich Plan was not without its merits. While it failed to become law, it sparked a conversation, a debate about the need for a central banking system. It brought to the forefront the issues of financial instability and the lack of a centralized control mechanism. Though the Aldrich Plan failed to pass, it laid the groundwork for what would become the Federal Reserve. It was a stepping stone, a necessary failure that would eventually lead to the creation of one of the most powerful financial institutions in the world. It was a cornerstone in the long and complex history of the Federal Reserve. In 1913, President Woodrow Wilson signed the Federal Reserve Act into law. This act was an answer to the financial instability that had plagued the nation. It was a response to the Aldrich Plan's shortcomings and the growing public concern over financial control. The Federal Reserve Act established the Federal Reserve System, a unique blend of public and private components, designed to serve the interests of both the general public and private bankers. It was a balancing act of power, attempting to decentralize control and prevent the accumulation of financial power in the hands of a few. The system was made up of three key components: The first was the Board of Governors, appointed by the President and confirmed by the Senate. This board was given the responsibility of overseeing the entire Federal Reserve System. The second component was the 12 regional Federal Reserve banks. These banks were strategically distributed across the country, each serving a specific district. They were the operating arms of the central banking system, carrying out the monetary policies set by the Federal Reserve Board. The final piece of the puzzle was the Federal Open Market Committee, or the FOMC. This committee was responsible for overseeing the nation's open market operations, essentially the buying and selling of government securities. This was a significant tool for influencing the amount of money and credit in the U.S. economy. This tripartite system was designed to provide a fair and balanced financial structure. It was a system that aimed to prevent the recurrence of financial panics, while also maintaining the integrity and stability of the U.S. monetary system. The Federal Reserve Act of 1913 was a remarkable piece of legislation. It was a testament to the nation's ability to learn from its past, adapt, and create a system that could weather financial storms. It was a significant step forward in the nation's financial history, a turning point that brought about a new era of monetary policy and banking regulation. And thus, on December 23, 1913, the Federal Reserve was born. Since its creation, the Federal Reserve has evolved and expanded its roles. From its early days of maintaining financial stability, it has grown to become the supreme authority in the United States on monetary policy and financial regulation. In the early 20th century, the Fed was primarily concerned with preventing banking panics and providing an elastic currency. Over time, however, its responsibilities have broadened. Today it wears multiple hats, juggling roles like a seasoned performer at a circus. In response to the Great Depression of the 1930s, the Federal Reserve took on a more active role in managing the economy. It was during this period that the Fed began using monetary policy to influence interest rates and control inflation. Its role as the nation's central bank was solidified, setting the stage for the pivotal part it plays in today's economy. Fast forward to the 21st century, and the Federal Reserve has become a crucial player in managing financial crises. During the financial crisis of 2008, the Fed used a variety of tools to stabilize the economy, including lowering interest rates to near zero, and implementing quantitative easing to inject money into the economy. Beyond crisis management, the Federal Reserve also plays a significant role in the daily functioning of the economy. It sets the nation's monetary policy, influences interest rates, and oversees the banking system to ensure its safety and stability. The Federal Reserve's duties have indeed grown over the years, but at its core, it remains a guardian of the nation's financial system. It continues to adapt and evolve, responding to the changing needs of the American economy while maintaining a watchful eye on potential threats. Despite its evolution, the Federal Reserve remains true to its original mission, to provide the nation with a safer, more flexible, and more stable monetary and financial system. Now, more than a century after its creation, the Federal Reserve still holds a pivotal role in the U.S. economy. As we've journeyed through the evolution of this institution, it's clear that the Federal Reserve wasn't just a spur-of-the-moment decision. Rather, it was a calculated response to the financial instabilities that plagued the nation in the past. Let's take a moment to appreciate the importance of the Federal Reserve in today's economy. It's the engine that powers our financial system, the steering wheel that guides us through economic ups and downs. Its ability to manage inflation, regulate banks, and act as a lender of last resort is vital to our economic health. The creation of the Federal Reserve was a pivotal moment in history, a turning point that marked a new era of financial stability and control. It was the product of a nation's struggle and resilience, a testament to the power of innovation in the face of adversity. Just imagine how different our financial landscape would be without the Federal Reserve. It's a sobering thought and one that underscores the importance of this institution. The Federal Reserve isn't just about dollar bills and banks, it's about the well-being of our economy and, by extension, each and every one of us. And so, the next time you look at a dollar bill, remember the journey it took to get there.